Hello, everybody. We want to welcome everybody to Connected With Latham, our podcast where we discuss ideas, legal developments, and business trends impacting the global economy. This is Haim Zaltzman speaking. I'm our Global Vice Chair of Emerging Companies and Growth at Latham, and I'm very honored and thankful to have the opportunity to speak here today with Brian Stephenson, CFO, and Neil Kumar, founder and CEO of BridgeBio, a leading unicorn biotech focusing on genetic disorders. Neil, I've worked with BridgeBio for almost a decade. And Brian, you and I have worked with, I think you try to forget it, but I think both before and when you joined, also about a decade, maybe eight years or so. Yeah. It's been a long time. I used to have the audience can't see my hair, but I used to have a lot more hair before I started working with these guys. But I want to welcome you guys, and I'm particularly excited to discuss with you guys your journey, the BridgeBio story. For our audience listening, BridgeBio is a superstar unicorn biotech focusing on genetic disorders and has a very, very unique or relatively unique structure in the way it seeds, develops, and finances. And we'll talk about all those parts in this podcast, biotech startups, and gets them from inception all the way to what's really important is helping people's lives and improving results. So with that, thank you both for being here. Wanted to start with both of you guys in your history together. You guys were roommates at MIT, is that correct?
That's right.
So before we start into more serious stuff about BridgeBio and the story, you each get one thing that was the most embarrassing thing that the other person did as roommates.
Maybe I'll start before that as
All right.
I think of the most embarrassing because it's hard for Brian.
Let's not talk about the tests I bombed.
Just start by saying thank you for having us here. 9.5 years of Bridge, and I think you've been here since the start, to be honest. And it's interesting, I was thinking back before we came in as to how I first got introduced. A long time ago, there was a royalty we were trying to buy associated with an asset for Gorlin syndrome. Brian was working for a debt provider. I called him and I said, how do we do this? And Brian was super helpful as always. And then he said, the world's very best person to talk to about it would be Haim. And so that's how I got.
That's very kind. I'll pay you. I'll pay you later for that, Brian. I'll pay you later for that. Right? I appreciate it. No, it's been an amazing journey with you guys. But I'm not going to let you get away with the most embarrassing thing.
I've got an easy one because Brian has always been cost conscious. And maybe third year of graduate school, he bought himself a used scooter that we were going to use to get back and forth to the local mall for Taco Bell, where we always used to go for dinner. And his scooter, the steering wheel was broken. So we jump on this little, I don't know, it's like a moped or something like that. Brian's driving, and on the way to the...
Don't picture this way.
No, I am. So you guys may not know, my first job was Taco Bell. Yeah. My parents made me pay for half my Chevy Corsica working at Taco Bell at the time. That was right. I told that. Wow. $4.25 an hour as a side
What's your favorite item?
Oh, it's the 7-layer burrito. It's not even close. Oh. They took it off the menu more recently, last 2 years, which really hurt me. But I can help you guys hack it if you want to re-hack the 7-layer burrito. Yeah, but that's amazing. That's amazing. So, and Brian, you?
Boy, hard to follow that up. I think probably what's most embarrassing was we were roommates even after MIT. When we started at McKinsey, I'd probably say that was embarrassing.
Fair enough.
That is amazing. So the reason that's important, obviously, is the relationships are important in law, business, everything. And obviously, you guys have started early. Who's the bigger nerd?
I would say you told me you were going to ask this question, and so we took a little poll. It was like, actually, you turned out to be the biggest nerd. We were actually very cool back then. Yeah, right. Hard to tell now.
I think you're truly a nerd if you think that's a badge of honor, which I think we would. So I think we would try to compete for that title, sadly.
That's amazing. Well, good stuff. Well, I'll have nerd T-shirts for you guys one of these times. So now that we got the relationship and kind of the fact that you guys get along and really like each other, which we think is very important in everything we do at Latham, we try to do it. Obviously, it's hard. What has changed, Neil, for you? And we'd love to just give a little bit of a more detailed description as the founder and CEO of Bridge of what, for our legal business audience of what Bridge does, and then what's changed about the Bridge portfolio over the years.
I'll try to be brief because we can drill into any piece of this. But fundamentally, the problem Brian and I were trying to solve alongside Andrew Lowe when we started Bridge was that we had identified a lot of great but early substrate to generate medicines that would matter for patients that were effectively sitting on the shelf in academia, and they weren't being funded forward for a wide variety of reasons by venture capitalists at the time. And we felt that the substrate represented, although it was years from the clinic, NPV positive and high probability of technical success, shots on goal that could really help people. And the way to finance it forward would be to create a novel entity of the ilk that Bridge ultimately came to represent, which pursued many of these projects at the same time in a diversified and highly efficient manner. And we can go into why all of that is the case, but the important part of the original view was if you could basket it all together, even in this highly uncertain world of drug discovery and development, the fact is you have a lot of capital that's required. You have a long duration that is incumbent upon each of these programs. But if you can put it together as a basket and you fast forward 14 years, you should, on a risk-adjusted basis, even if we just did a historical probability of technical success, you should have adequate returns for both debt and equity investors and remarkable returns for the patients that we were attempting to serve. And so I think that still remains kind of an interesting thesis for us. What has changed over the years, and we can get into the specifics of it, though, has been the dependence that we've had on what I would call path dependency. Right through time, people come to appreciate different parts of the portfolio, and we have to respond to that, both financially as well as how we pare back or expand the pipeline. But I don't know if that captures it.
I agree with all that. I mean, maybe just broadly, what's changed is early on it was all early stage research and R&D work, and now the portfolio is later and later stage, and the scope of what our central services provides to each of the affiliates has changed with that, right? So the operating model continues to shift.
Yeah, no, that's fair. And you obviously mentioned some things here that we'll drill into, like NPV and financing. But before we do that, I do want to focus on the science a little bit. And you mentioned R&D, Brian. And this is actually a question that's very important, and it's something I do want to highlight is you as CFO still have to constantly think of the science. And be part of the science discussions, because if the science is amazing but you feel like you can't finance it, there may be some difficult. So what do you, I'll start with you, Brian, as CFO, look for most as a science fit for something that BridgeBio would invest in and develop and nurture?
Yeah, great question. I mean, I think I just start with, we're fortunate to work with a group of luminaries as part of our investment committee here. So does the investment committee at the end of the day think this could work? Right? We really start with that. Do we think this bet could work? Second, I'd say is probably just the size of the market and how durable the market's likely to be that we're going after. And then I'd say third, we were looking recently at, updating our NPV modeling of our portfolio and incorporating real options in that. And one thing that is true is the more go and no-goes you have on a program, the more a real option is worth, right? So if you have clear go, no-goes and multiple of them early on, that certainly helps us.
Interesting. And Neil, is your view mapped pretty directly on those, or this is a setup to get you guys to what's your top three in each and see where they compare and contrast?
Yeah, I mean, I'll elaborate on it a little bit because obviously at the start, I remember, we had a couple principles, and our one of the most salient ones was the correct target and intervention selection, like working on the right problems, is 99% of the value that we will create. So we think a lot about this. And I wouldn't say there's three attributes. There's a single attribute that we look for when we're getting into a new space, which is how well connected is genetic dysfunction to phenotype. And we're both engineers by training, and we like systems where you can go from here's the mutation. In a fairly predictive way, the mutation does this to a protein. In a fairly predictive way, the protein does this to the cell. In a fairly predictive way, the cell manifests either cellular toxicity or extracellular matrix toxicity. In a certain predictive way, that happens to affect the tissue in a certain way, and then ultimately it manifests in the phenotype that the patient feels. When you can describe a system with that clarity, which is really only plausible in Mendelian disease and a few other diseases, but it's not plausible for things that are broad, like diabetes or something like that, because you've got genetics at play, you've got environment at play, you've got all sorts of different things. But for the class of disease we work on, you can describe the system that simply, and then you can come up with an intervention that targets the causal driver at its source. If that is possible, we by and large will like that problem. And the reason to pick that science is not only on a retrospective basis, that area of science, what we call genetically validated targets, is about fourfold higher in probability of technical success. It's also an interesting space, and we thought this a decade ago, and we still think about this today. It's an interesting space because that's where a lot of profound innovation is occurring. And that happens to be the case because we have ever decreasing costs of genomic and exome sequencing, coupled with better databases that put all of the information I just described in the system in one place, like the UK Biobank.
Yeah.
And then we have all these new modalities that allow us to target these diseases at their source, right? We've got gene therapy, and we've got ASOs, we've got small molecules, we have protein replacement therapy. So all of that together is what we look for, I think, in the science.
Interesting. So if I may, like, kind of distill that for the audience, I always like to look at problems via the games you can play for them. So I always view as, is it a chess problem or is it a poker problem? And you're sounding like BridgeBio and the team is more likely to want to do an investment and focus on something if it's a deterministic chess game, right? You know where you're going to map out as much as you can. You see the full board rather than a stochastic poker game where, someone can come in with a bigger pile of money. You may have the best hand, but someone may bluff you better. Is that a pretty good analogy, just so we could have like the game?
I mean, I think at the individual disease level, we like the deterministic system, still understanding that the concept of swallowing a pill, it's transitioning through the gut, getting into the bloodstream, engaging the right protein, and then changing behavior downstream. That's still a super nonlinear problem that is not deterministic. And so it's higher probability of technical success than all comer, but it's still less than 50%. So what does that mean? That means we aim to be an engineering company almost by taking the most deterministic of problems, but then at a portfolio level, we think about it much more like poker. And so like there are things, to Brian's point, real options theory, for instance, comes out of gaming, or elements of it come out of gaming. And like, I think you can look at that, like what hands do you want to fold? Where do you want to double down? That's what we're always thinking about at a portfolio level, because most of the stuff that we work on will still fail.
That's a great analogy for both your strategies. You both have deterministic chess strategy at an individual where you try to determine it, and then you play the poker game in terms of the stochastic and what changes in the world and where you need to.
And by the way, that just going back to the founding principles of the company, that was what made this sort of decentralized model so important. Was at the level of each chess game, you want experts in that game, right? So that whatever that chess strategy is, or chess and chess alpha and beta. So it's like that feels like a biotech, right? People who really understand that area of biology. But then the question is, how do you assemble the portfolio still at one company? And the tension between those two things is what creates the corporate model. Focus at the level of each biology, so we have incentives down at the level of each affiliate that's working on a specific disease state. But then centrally, right, we have many bets so that we can shut down things that aren't working, double down in areas that are. And then the centralization of resources that aren't necessary for specific biology allows us to variabilize a lot of what would otherwise be fixed costs, and that makes us ever more efficient. So all of those things together allow us to run the diversified portfolio, accounting for the risk that's attendant in biotech, to get the focus that allows biotech to be more productive historically than pharma at the level of each program.
Love it.
And then to drill in the efficiency, less than $10 million to IND, et cetera, that allows us to, in an NPV positive way, go after each one of these genetic bets, unlike pharma that needs $1 billion+ markets always to win. And then just to round out the gambling analogy, if you think
which we're going to belabor throughout this podcast for sure, because everybody gets it.
On the Edge by Nate Silver, and we're all excited. But like, I think that overall biotech has been understood broadly by many investors. Stelios, I think, is maybe the most famous for saying this as being an EV negative game.
Yep.
Like, it's just like slots, but it's still exciting to play because if you time it right, you can make some money, and it's an important thing to do for society. Our firm belief from the get go was that you could make it an EV positive game, and making it an EV, like, why do we talk about NPV? We're going to talk about it a lot during this podcast. We talk about it a lot. No one really cares because typically people are not holding a project from beginning to end in biotech. They're playing some part of the system, and that's why. But our hope is that if we can demonstrate that it's EV positive, we could attract a lot more capital. So instead of it being like slots, which is effectively EV negative but still attracts capital, can we make it like some other game, which is EV positive? And that's why we're so focused on lowering our cost of capital through time. It's why we're focused on limiting cost, and it's why we're focused on elevating probability of technical success. Those three things together allow us to maximize MPV and hopefully make this an EV positive game.
Before we jump on to the direct side of finance, if you had a choice of the right game that personifies what you do in BridgeBio, because clearly it's not chess and clearly not poker perfectly, what would it be?
I think one good analogy is a horse race, and what do you bet on each horse at the outset? And then what do you can change your bets over time, which is a little different than a horse race.
Yeah, but no, but you can, if you have 3 horse races like you do in the arenas, right? Interesting.
Yep.
So speaking of horses, everybody needs to get money to run. You got to feed them. You got to do all that stuff. So in terms of monetization and financing, which obviously it's important for every company, but in terms of what BridgeBio does specifically, financing the portfolio, what has changed over the years? Where did you start in terms of your theory of doing it, where you're going to access the funds? Obviously, we've seen a lot of change overall in the world of finance generally, including private capital, which was obviously the private lenders who were a huge part of the big royalty and debt financing that we closed with you guys earlier this year. The largest one still of the year, by the way, just so you have that. And I doubt it's going to be beaten, although I'm hoping I don't jinx myself with a few weeks left in December. What has changed? I mean, you guys are grizzled financing experts. You're trying to finance, and you've done an amazing job with a unicorn company over a decade or so. Other than like the size, what have you seen change in terms of? And I'd love to limit you to 3 things because I know we could talk about a lot of variables and get down to what maximize NPV in the story. But what have you seen change? I'll start with you, Brian.
Maybe I'll start with what stayed the same here, which is even at the outset, our hope was if you have a relatively broad, diversified, uncorrelated portfolio, it should be possible to attract non-traditional, non-equity forms of capital to the story, right? And it's been heartening to see that play out as we've worked together for these years, right?
Yeah, it's been amazing.
And that stayed the same, I think, for a long time. I think what is probably a bit different now is, whereas early on, this was very much a equity and debt financing story. Now we're more at the stage as we get, pivotal trial results for programs or get to approvals where royalties can be a big piece of this story.
And by the way, I know I've told you individually, but congratulations again for the huge news on the FDA approval a couple weeks ago.
Thank you.
Yeah, and we love royalties. We love everybody. Was that always something that you thought of was going to be an option?
That was actually part of the original founding vision with Andrew Lowe.
That's right.
He wrote about that, and as the company evolves, its natural base of investors evolves over time as well, right? So that's where we're at now, is managing that transition.
Got it.
But royalty investors are quite appealing, I think, in an environment where equity's pretty beat down, right? The street tends to like very focused single asset stories or relatively focused stories. So we think looking to different sources is helpful.
And Neil, since Brian kind of laid out probably the negatives in terms of the changes, things you weren't expecting, and because obviously you don't win every hand, or there've been things in the monetization financing world that like you would say, crap, I wish I would knew this was coming, or I kind of knew the this would be harder than it was.
I think going back to what I said earlier about path dependency, those things have been most surprising to me. So I think, to Brian's point, what was not surprising is that this diversified portfolio was able to bring a whole set of investors that I don't think were commonly associated with biotech into the game over time. But I think what I personally have been surprised by is that, for instance, cost of equity has changed so radically over time with maybe one asset. And the vagaries of that have affected the diversification with which we could play forth our our portfolio. So that's one thing that's changed. I mean, the other is obviously that we're later stage now, so there's more financial tools available to us than at the beginning. And then the third thing I think, which has been a little bit of a negative, has been when we started, we thought there were many other ways to capture value in the biotech market, but really it's only owned recurring revenue. So, a diversified model like ours should be able to respond by taking minority stakes in things, spinning things out, et cetera, et cetera. Like, well, I think, us, Roivant, others who have played this model out have realized that it has to look like a biotech and own revenue for it to capture real value. And it's very difficult for people to value other stakes, be it pre-commercial royalties, be it minority stakes in other companies, et cetera. So that's another thing that I think that's changed over time.
Yeah, I mean, I have a couple questions later on, and like who would be a great kind of financier for you. But before we jump into that,
I mean, but not sorry to cut you off,
yeah,
but,
no,
but I
please,
think like
please.
one of the things that I think about a lot is if you're playing this game that you really care about playing it in an NPV positive way, and it's a super long duration, high capital intensity, high risk system, like who's gonna start with you and then see the end product of that? And if there's not a lot of people who are going to do that, then you're kind of playing these mini games inside of the broader game that you're attempting to play, which is how do you appeal to a shorter term investor at that very moment? And that changes a lot over time. So we're starting with contrarian bets, obviously, because no one else is doing those things, right?
Right.
I'm starting with an academic who literally can't get their project financed. But that contrarian bet has to turn into something that's mainstream or orthodox at some point for me to get value from it. Now, ultimately, if I could design the game, I would say I just get to prove I'm right or wrong based on the cash flows that are associated with this project. But that's a 20-year journey,
Right.
right? So Pablo was able to do that at Royalty Pharma. He didn't have to take royalty public because he started a little later. We're starting super early where we need a lot of capital. And so I think every surprise that we've had has been like, wow, our ability to play a mini game at that very moment in time has evaporated. Like
And
right now, genetic disease is not popular.
Yeah.
So like it's hard for me to finance some of this stuff.
Right. And is that because the global macro situation changed, or the investors' focus have changed? I either become shorter term versus longer term. Have you seen tectonic changes in that direction, or is it a mix?
I mean, you cannot understate the tectonic change that has occurred in the biotech marketplace over the last 3 years. I mean, the pullback is as dramatic as the tech bubble bursting.
Right.
And so I think what has happened is most of the alpha that's been delivered to investors in the public markets has come through M&A. And M&A focuses on obesity, I&I, and oncology recently. And then VCs in turn want to do the things that are popular for public markets investors and or pharma, right? So on down the line, we've seen this not follow on effect that's made the area that we work on more contrarian. Ultimately, I think these drugs are like NPV positive, in some cases wildly NPV positive, and I think we've got the right way of prosecuting it. But yeah, I think the markets and their changes have made it even easier for us to find great new projects,
Yeah.
and even harder for us to capture the value of it. I don't know, Brian.
Nothing to add. Yeah, I agree with that.
And has that changed? I'm assuming, everybody keeps on talking about the value of death in terms of financing. Obviously, for you guys, it's very different on a macro enterprise consolidated level versus a micro individual portfolio. Do you still experience the value of death for individual portcos? And is that the way you look at it, or are you looking at it as a combo because you can use now the consolidated balance sheet approach to help that portco?
I'd probably say yes, we do experience it in that, M&As, hot areas ebb and flow over time, right? They change. And so we're subject to that. We feel that, we experience it.
Yeah, I think at a mini level or a project level, the Valley of Death is still academic, has a great idea. No one wants to finance it. It's 3.5 years from the clinic. It's a small molecule and it doesn't affect some big narrative like CRISPR-Co or whatever, right? So like that's the Valley of Death that we partner to address. And we're able to do so because we have the diversified now later stage portfolio. So we have capital that we can bring to that system. The Valley of Death that Brian is articulating is what we experience as a company that drives our cost of capital up. And that can move over time because value inflection has moved over time. And I'd say like right now we're experiencing the second Valley of Death, which is like post phase 3 pre-launch, where no one thinks you can launch against other competitors. And so our cost of capital has gone up. So we too experience it as a mega entity.
Mega entity as
Yeah.
well. That makes sense. So back to the portfolio theory model that is BridgeBio's core. Do you, and this is a math question, but I do want you guys to nerd out on this. Do you think you can ever get large enough portfolio companies to have a truly diversified, I'm using air quotes for our audience here, portfolio to truly get the benefit of what you guys discuss in that Harvard Business Review and HBR article of getting that EV positive, or is it just really hard to get large enough to do that?
That's a great question. I mean, I think what's interesting when you look at our portfolio and how that's evolved over time is a more focused but later stage portfolio can still have more expected approvals than a broad, diversified, very early stage portfolio, right? So I think we actually have shown that that portfolio model can be realized and continue to show that. It was a challenge after the Part A result for a True B that was negative ahead of our positive Part B result. We had to stare hard at the portfolio and think about what we keep moving forward. But even where we've landed with that, I think it's, an increasingly uncorrelated basket of things that are likely to hit, right?
Yeah, I mean, I think you have to ask the question, what is the point of diversification? For us, diversification was important because we felt as we diversified more, we decreased the probability of default and increased the probability that debt and equity investors could get paid back. And if you look at the number of programs that we had even early on, we were getting there. It's just like, I know Andrew wrote that paper in Science Translational Medicine. I think it was like 25 programs or 30 programs, brings the default risk down to a level where you can get your debt rated. Now, obviously, we don't have rated debt. It is something we aspire to ultimately, but that's not because of the number of programs. It was really because I think the database associated with probability of technical success is not well accepted in the same way a mortgage database would be, or student loan default rates would be. So I think we're adequately diversified. Obviously, the rate limiters on the number of programs is a little different. I see it as like, it's either new science that meets our bar, the number of people we can recruit, or the financing that we can attract. And typically it's been that third that has limited the amount, either the financing we attract or the cost of capital. Because if our cost of capital is up in the 20s, all of a sudden something that we could have pursued at a 14% cost of capital becomes NPV negative.
Got it. Interesting. And then the cost of capital is really important broadly for what you do, but also for, since you're a public company, how the market looks at you and values you. And so the question, and I know it's kind of a hot potato question, but I'm going to ask it anyways. Can the market value the diversified portfolio correctly in light of what the broader public market is looking for? Or is a private player like a private equity shop better at looking at a diversified portfolio, their recurring revenue, etc.? And have you guys thought about that in terms of how you communicate to the market about the portfolio and the financing, the need for financing?
It's a tough question.
It's a hot potato. I told you. I'm from Idaho, so I get one hot potato question.
I think since we do aspire in each one of the programs we take on to be first in class or best in class, ultimately those are the types of profiles that strategics do, seek and see value in, recognize value in. So I think it is possible. It may not be possible for the entire portfolio at every moment in time, but it's certainly possible for at least a select few within the portfolio. That'd be my answer, but yeah, I don't know, Neil.
Yeah, maybe I'll be a little bit more negative on the ability for the conglomerate discount to be avoided in a marketplace, especially a marketplace that's geared very much toward M&A right now. I'm not saying it's true of all marketplaces all the time, and it may not be true of all stages of our company, but I think if you blew up the company into individual assets today, or you found a set of private investors to take the company private, you would avail of the true value of the company more closely than we are today availing of that value in the public markets. But that again could change over time. I think that's number one. Number two, we've taken steps to address that through the deconsolidation of the company this year, right? Spinning out Gondola, spinning out BBOT. So we do understand that in certain cases, there's just a set number of programs that public markets investors are willing to tolerate, and we've been trying to respond to that.
Got it.
By the way, that hasn't always been the case. It was true for some time that like this sort of diversified model was popular with debt and equity investors. I think it's true now that our debt investors tend to do much more Monte Carlo portfolio modeling, whereas our equity investors tend to focus on one, maximally two assets in our pipeline.
Yeah, and again, for the audience listening, that the need to balance obviously debt and equity is a unique skill and something that BridgeBio has obviously done very successfully in light of the portfolio model. The need for it. Many companies just focus on one or get to cash flow positive and really don't worry about the other. So kudos for you guys for being able to balance it. It's a needle to be threaded. Cool. So I am a lawyer. I know people forget that. So the last question is not your favorite topic, but it is about the law. Or second last, we'll get to a few more joyful questions at the end. We're very obviously aware of BridgeBio's legal structure. We've been in a journey with you, Neil, from the start, and as you joined with the portcos and the holding company structure. It's very hard to thread it in terms of what each individual investor will want, how you want to structure each company, and obviously the tax makes it more difficult. From your perspective, what would have been one thing that would have made the legal structuring, the legal structure easier over the years? And it's fine, by the way, to blame the law or blame individual administration. It's not. This isn't the hot potato question. We already passed that one, but it's like what would have made it easier so you guys would have had to spend less time with me, basically, over the years.
Well, I'm happy to start with that. I mean, I think one thing that would be helpful for us at this stage of our journey is, if the courts recognize that synthetic royalty monetizations are true sales that hold up in bankruptcy,
Yeah, sure.
that's just helpful for companies that have both senior secured and are looking at royalty monetizations.
Interesting.
It's workable, but it impacts cost of capital.
Yeah, we obviously discussed that in detail, but that wasn't what I was expecting. I guess I was more focused on the tax return. But we're hoping that the courts will sooner or later. It will be tested in a bankruptcy in a more cogent way. But there may be a couple of things that we're aware of that's coming to the pipeline just as individually. We'll see. We'll see.
Yeah, it's a hard question. I mean, I think there were mistakes that I made in structuring BridgeBio early that, I could better anticipate today, mostly in terms of what's doable from a tax perspective for our investors. So you remember probably the, Series B, Series C, like we didn't house employees in the services co in the appropriate way. There were like lot of learnings there. But the biggest for me is I always hate it when tax law effectively drives the strategy of how we're trying to create these meaningful medicines for patients. And the issue for us is like as a private company, you're an LLC, so there's ways to monetize assets along the way that can better support early R&D. But once you're a public company, again, if all that's recognized is own recurring revenue and you can't tax efficiently dividend things out because it gets double taxed and you're an ongoing entity, that becomes very difficult and effectively really does affect the strategy of the firm. And so if there was more flexibility around, LLCs being public or, the tax law that allowed for one-time dividends in that manner, I think that would be also advantageous.
Definitely food for thought and food for potentially the new administration, which is my next question. This isn't a hot potato. It's more of a kind of a wish list, and we all have it. I think everybody's happy that the election is over. And that it was peaceful, and we're here calmly now. Looking forward, what would you want? And I'd love for you to limit it to one thing, but to see in the next administration from a biotech law structuring. Obviously, you mentioned the courts, Brian. I don't think the administration could nail that, but maybe they could on how to treat royalties. But what would be the one thing you would like to see from the Trump administration?
Maybe I'll start. I mean, I'm very hopeful that we can take a new look at, I think, what's already working, but could work more effectively for patients in and around the idea of equipoise within the FDA. So, a lot of the early legislation that governs the FDA, as you know better than I, Haim, was written decades ago and pertains mostly to large markets and follow-on molecules in large markets like hypercholesterolemia, et cetera. There's a very different calculus that needs to be applied to a drug that is being prosecuted for a pediatric disease where with 100% certainty a child will die in the next 2 years. I mean, the fact that we are required to run non-human primate studies to rule out at a p-value of whatever that there will be no toxicities at these doses, I think can be reevaluated in some cases. And I think in some cases you're seeing that. And the concept of how quickly we can get medicines to the market for these devastating conditions, there can be a multiplicity of pathways. The same pathway doesn't need to be attendant for obesity as is for Canavan disease. So I'd love to see a bit more of a focus there, and I think we will see it. To be honest, just given some of what we've heard from the incoming administration.
Yeah, that's a good point. I'd probably pick just approval timelines generally, right? The time that lags between positive phase 3 data and when a patient can actually get a drug, as physicians and patients are waiting for a life-saving medicine, it really does matter. So, we were fortunate to just get an approval a week early on a Truby, but patients are waiting for this drug. So
Yeah,
in my
yeah.
mind, that could be a priority.
Yeah, and obviously these are both things that are in focus with this administration. So hopefully, and we haven't spent a lot of time on it, but obviously the diseases you're focusing on indicated are very important, and are some of them are fairly rare and are devastating. So yeah, getting this stuff out there is key, which is obviously the ultimate goal of everything that you guys are doing is to get the product, to get the cure out there.
I mean, as a society, what could be more important to focus on than a child's health? And from a productivity standpoint, you think about every child is going
Every
to be a
year, what's yeah.
meaningful contributor to ultimately the nation that we're building together. So if you could deploy tools like AI and others to, expedite some of these review processes, um, every minute matters for the patients we're trying to help. So I think there's a great opportunity, regardless of the administration, to be honest, to revamp some of these things.
100%, huge focus, and we need to get our targets on the correct stuff for sure. I'm gonna skip a question that your internal legal team begged me not to ask you guys about M&A and licensing, so you won't get you in trouble.
You can ask anything you
No,
want.
no, 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 no. Yeah, I know who ultimately approves of invoices, so it's good. No problem there. But I do have a fun, what I call a speed poker game, since I love the games, and I'll do this as quickly as possible because I know I've already eaten up a lot of time. I will try to get you guys to be very succinct here. What's the largest professional obstacle you face, Brian?
I'd probably say the decline we saw in our equity value post Part A. And it was just a window when we had to get our essential services costs way down while trying to keep programs going. And what we learned is you can always cut costs. You can always be more efficient, but it was tough.
Neil,
What's the biggest obstacle we do face today, or that we have
you
faced?
faced.
I agree with Brian. Post Part
Part
A,
A,
just
Part A,
just reacting to and making sure the firm could stay alive.
Okay, staying alive is important. Ideal teammate, education, experience, temperament. Those are the things I focus on because I'm very simple. I can't really get into like multi dimensions. Brian?
Honestly, I think it could be anything. It's great to work with someone who has like a complementary set of skills to your own. But generally speaking, I'd say just someone who's a builder, not just a warrior, because I can worry plenty on my own.
Got it. That's a very cool answer. Neil?
Education, experience, and temperament. Risk neutral on temperament. As experienced as possible, but not heuristic driven. So experience without being stuck in pattern. Education. I mean, we go everywhere, but we tend to focus on the super high quality educational institutions. I know that sometimes maybe controversial, but in today's world, I think it's easier to recruit from great labs and great educational institutions. And then I just add to it, one of the things that we really look for is just some sort of a chip on your shoulder, something that makes you wake up at 3 a.m. and think, man, people are doing this wrong. I want to do it another way.
Right. And there's, obviously we share some educational experience, and it was very important to, I'm sure, all our parents to get us the best education. So I actually, love the folks who would be proud of their credentials in a positive way of what they actually got them, rather than just a heuristic of what the name signals. And just for the audience, Neil and I recently realized that we went to warring high schools. He's an Andover alum and I'm an Exeter alum, and yet we're still here and getting along still fine. So it's all good. My poker table question. This is my favorite, and again, I'm focusing on poker because I do think it's the hardest game, because regardless of how well you play, that may not be enough sometimes. And I think that's the best metaphor for life. That you got to just keep on playing the game, position yourself. So for BridgeBio today, if you could adjust one thing on the poker table, is it the game itself, which I broadly equate as a broader economy? Is it the table, i.e. the biotech industry and some of the focus areas we're talking about? Is it the house, i.e. the regulatory regime, government affairs? Is it the stack of chips, i.e. how much money you have behind you? Or is it the other players, folks not playing fair, other biotech or pharmas not being coordinated and doing stuff that's, cutting the nose despite the face up stuff? So I know it's kind of a loaded question, but it is by far my favorite. So Neil, we'll start with you this time and let Brian finish off.
Well, I guess I'll start by challenging the premise of the question because I do love playing poker, but I see poker as a zero-sum game, effectively, and I don't see biotech that way. But let me try to extend my understanding of poker, where there's kind of like game theory, optimal, and then there's sort of, I'm playing my opponent, and I think that if we could come up with algorithms that make game theory optimal work for everyone, which I think we could, which I think that's what we're trying to do here, then what you're waiting for is the broader market. So I don't know what in your analogy that's the house or the table, I don't know what it is, but to catch on to that, and then I think just attract more capital to the thing that is, going back to my opening point, is EV positive for everyone who plays it in the right way. So it's if the algorithms are right, it's like in poker, if your algorithms are right, you can still lose because, people are onto you and then blah, blah, blah. But in this case, it's not really zero sum. The algorithms are right. We can create great drugs that matter for patients reproducibly. We just need to convince people that those algorithms are right and then get a bunch more capital that's generalist into the space.
And then obviously with the diversification of your portfolio, that makes that play even more realistic.
Diversification, and also the fact that each program is NPV positive.
Yeah.
We have to convince someone that mattered. It mattered that we did ATTR through phase 2 and $88 million. That it mattered that we did achondroplasia in less than $70 million. That it matters that our probability of technical success is about 50% higher than it is common in genetic disease, which in turn is fourfold higher than the rest. If you can convince people that matters, and then you find that patient capital that wants to take those 15, 20-year bets, then you're off to the races. That's a great game to play because it's rigged in your favor.
Everybody likes me in the house. So I love the answer and going after the premise, but I'm not going to let you get away without telling me which part. And I think you said, I think you're leaning towards the table, right? It's a biotech industry. It's the understanding the full NPV positivity of each of the assets relative to, I think, if I may, I think that's what you would change.
It's some cross product of the game itself and the table,
and the players, right? In a way, you're trying to attract more players to the game. Ultimately.
Yeah.
Right.
That's
interesting. Okay, Brian, you?
I guess I can't answer. I want all of them to be slightly better, can I?
I mean, you can, but that would be a legitimate cop out. So
I'd probably answer the house, I guess, in that, if we're all living on borrowed time, and we are, I'd argue it would make sense for society to say we're willing to pay more, not less, for life-saving drugs, ultimately, right? So kind of the government context, the regulatory context to support that would be what I change.
Interesting. Great answer. Swinging the other way, speaking about life and valuing things, I love food of all kinds, including I'm still a Taco Bell fan, even though, some people were like, oh my God, you worked there, you saw the animal. And I'm like, I love it. It's every road trip back. That's what my family lets me do, is stop at Taco Bell. What's your favorite food? And it can be anything. I mean, high genre, I love this dish at a Michelin star, or I love this street food. Give it to me.
I love food. I love cooking, but I'll stick with the Taco Bell theme. Chili cheese burrito is an item you can only get in the Midwest at Taco Bell, and I love that. And then the chicken quesadilla with no sauce. I don't like that green sauce.
Oh, you don't like the green sauce?
No, I was like, those two are up there in my in my culinary hall of fame.
That's how they get the salt into you know that, right? The sauces are all it's amazing. So it's as a joke, kind of, but. When folks order the bean burritos, which is obviously still one of the most popular food without the red sauce, Taco Bell doesn't love that because the sauce is very salty and it's going to make you drink more, and that's where all the money's made, is in the soft drinks.
Oh, really?
So just FYI.
Oh, layers to that business model.
There are not many layers. It's pretty obvious, right? Everybody knows that you make the money in the drinks, right? So Brian, food?
Well, as much as I love that spectrum of food, maybe I'll probably say answer on the other end of the spectrum, which is if there was one thing that I would eat for the rest of my life, probably sushi.
Sushi. All right. Any particular like food? Can you get like a restaurant that you like love in San Francisco or New York, or
I'm not picky.
you're not picky?
Yeah,
All
not
right.
really.
All right. Good to know. Well, look, I really appreciate you guys. We're coming to an end here. I want to obviously thank you for your time. Thank you for BridgeBio and what it does in the market. Other than obviously a great opportunity for myself and our Latham teams to work with you guys. We really are proud to work on stuff that changes individuals' lives so significantly. And, you know, it is, you know, when we try to attract young associates to work in law, working on stuff, even though oftentimes you roll up your sleeves and you're doing stuff that's similar regardless of industry, working on in life sciences and biotech and the kind of stuff you guys are doing. It's much easier to recruit, and we love that. It's really about it. So I also have a gift for you guys each, a valuable Latham pen, but more importantly, it's a copy of the latest guide, kind of a reference test. I actually do think it's terrific, from Spark, which is Stanford's biotech incubator. We do a lot of work from there. I actually know one of the Spark's person, the head, Daria Mockley-Rosen, since I was a Stanford sophomore randomly, and I helped co-author one of the chapters on monetizations in there. So take that as a gift, have it as a resource on the side, and we look forward to having this go live on Connected with Latham, which is one of the largest legal podcasts out there. And with that, thanks again, and thanks for your time, guys.
Thanks for the book. And maybe I'll just end also by saying Atrubi, which is our recently approved product, came out of Spark.
Exactly, yeah.
And
You actually knew that. I actually reached out when I saw it to Daria.
Yeah, Daria and Kevin, and
Congrats,
you know,
that's
a
right.
piece of that approval is Spark, and a piece of that is you. So we appreciate the partnership, and thanks for everything you've done for Bridge.
Thanks for helping us get here.
Yeah,
Yeah.
absolutely. Thank you to our listeners for listening to this great podcast with Neil Kumar and Brian Stephenson's of BridgeBio. You can subscribe and listen to this and other episodes of Latham's podcast, Connected with Latham, on lw.com, Apple Podcasts, Spotify, and wherever else you get your podcasts. If you have questions or would like additional information, please email us using the links in the show description. Thanks again, and we hope you will join us for future Connected with Latham episodes.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.